You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo.
Hey, what's up, Market Moose? Mike from The Moose on the Loose. I hope you're doing well on this Tuesday. For today, in the next following 2 days, we're going to do a mini-series on what 2025 has in store for some of my favorite stocks. So not all of them. I'm not going to cover like all the companies that I own. Of course, it's going to take a lot more than 3 episodes, but I just thought of like giving some quick overview of what could happen in 2025. So pulling out my crystal balls. Not necessarily telling you that it's going to be through, but you know what? It's just fun to reflect on your holdings and be prepared for what could come. In the end, we're talking about short term. Whatever happens in the next 12 months is not that important in my opinion. But what's important is to see the major trends and to see if one thing that happened maybe last year is going to continue this year, and then it becomes a trend, and then this becomes interesting like factors to analyze in your investment. So today we are going to talk about the financials and technology. So big episode, a lot of stocks. So get ready because I'm going to wrap this up in 10 minutes anyway. So in my financial sector, like those are like the 2 biggest sector that I have across all my portfolios. Financial sector, I do have 2 asset manager. I have Brookfield and I have BlackRock. So for Brookfield, it was an amazing year in 2024. So, and it shows that sometimes you just have to be patient. After they made their most recent reshuffle, because they just love to reshuffle their stocks and their shares and everything. So it used to be Brookfield Asset Management. They spun off Brookfield Asset Management, BAM, as an asset light manager. So just charging fees, like recurring fees, to investors, and then created Brookfield Corporation, which is the parent company. So if you want more yield, you want to go for BAM. If you want more total return, low yield, high growth, and have like the mother company of all of those, this is Brookfield Corporation. So for Brookfield, it was a great year in 2024. I kind of expect that, well, of course, those two companies, Brookfield and BlackRock, will follow the market. So if the market goes down, they will go down. I mean, it's kind of like normal, which is kind of ironic because Brookfield is all about patient capital and like real assets. So assets that are like alternative assets that are not necessarily traded on the market. So it should not be influenced like this, but it's the way it goes. So for Brookfield, what is great is I just look at their funds from operation and I look at where they're making deals. And I don't really care where the stock price goes. As for BlackRock, I have a little star in my book to follow this one a little bit closer. It's going well. Great business, largest asset manager in the world, largest ETF manufacturer, which is like one of the biggest investing trends over the past 10, 15 years now. Amazing business. But their 2 recent dividend increases that were like in 23 and 24 were about like 2-3% each. They're about to disclose their dividend increase for 25. Based on that, if it's another 2%, I will have to reevaluate the reasons why I have BlackRock in my portfolio, because it would not become a strong dividend grower anymore, and I would have to think about it a little bit more. So I love the business, but it would not be the first company that I sell because it's not matching my strategy. It's more important to be true and to be loyal to your strategy over the long run. National Bank and Royal Bank are also part of my portfolio. So for Canadian banks, it was a great year in 24 for them. I really like the diversification that both companies have. National Bank seems to be on a roll. They will complete the acquisition of Canadian Western Bank this year. Maybe it's going to rough a little bit the stock price. I mean, it's going up for a long while, so it would not be surprising if this year it's not an amazing year for National Bank. But in the meantime, They show consistent revenue and earnings per share growth. They have a clear strategy. They execute it super well. So one thing that I'm going to look at is their international and US expansion. So international in Cambodia. So it's always tricky to invest in developed countries under development. And for like Credigy in the US, it all depends on the US economy as well. As for Royal, the only thing that bugs me a little bit is right now it trades at a generous valuation in terms of price earnings versus their average. So on average, banks are like usually trading like 11, 12 times their earnings. Now Royal Bank is at 13 times the earnings, but there's still a lot of potential. They just acquired last year HSBC assets. I think it's going to be a good year for them too. The last company that I have in this sector is Visa. For Visa, I mean, if I had to buy like Visa or MasterCard today, I may choose to go for MasterCard, just mostly because in general, I like to own the leader in the market and the largest player, which is Visa, and that's why I have it in my portfolio. But now they're going to go into a little bit of drama with the DOJ pursuits, like legal issues around antitrust law around their debit cards, business ways of doing things. It's going to drag for several years. I don't think it's going to materially impact the business in 2025, so it's not the end of the world, and that's why I'm still holding this one. If you already have MasterCard, you're probably better off with it, in my opinion. But I mean, that's just me talking. Maybe I'm going to be wrong. I'm still happy with Visa. It has been doing very great. I just love the fact that everybody uses their credit cards all the time. They're just like cashing on recurring fees as well. As long as the economy is doing well, Visa and MasterCard are just going to rack up like high single digit to double digit revenue earnings growth, like they've been doing for several years. So one of the perfect business model, almost perfect. I mean, now like DOJs are going after them, so we'll see how it goes. But for now, the even the P ratio doesn't seem to be that bad versus their average, so that's great. Moving on quickly to the technology sector, I do have like three major positions. I just recently sold my shares of Texas Instrument, so now I have Apple, Microsoft, and Constellation Software as my three pillars in this sector. It's going to be a tale of PE expansion and valuation, especially for Apple. For Apple, there's of course a lot of like hopes and a lot of expectations from their artificial intelligence strategy. They have introduced Apple Intelligence, AI-driven tools, like set of tools, in 2024. We'll have to see how it develops. It's of course quite promising. It's Apple, everybody loves it, but at one point it's trading at a relatively high P ratio versus its valuation. Right now it is sitting at 10% of my portfolio, so I may have to trim a little bit because now it's 10 point something percent, so it's getting close to 11, so I may have to sell a little bit of Apples throughout 2025. I was almost ready to do it during the holidays, but just because it was not above the 10% mark, I just decided to like stay still and wait a little bit. But I just don't want to be overexposed to one stock. So this one, I may be going to sell 2% of it throughout the year. But that's just like good portfolio management with rebalancing the money across other companies to make sure that I'm well diversified. It has paid me very well over time, so I'm going to continue to stick with that strategy. As for Microsoft, ironically, trading at a like average P ratio, like a decent one. The company has many growth vectors, of course, including AI, but their cloud business is doing very well. They also work on their gaming stuff with the acquisition of Activision Blizzard about a year ago. So they have like a lot of things on their ends. Their product suites with Windows, Dynamics 365, Office is still racking up a lot of recurring revenues year over year. So I'm not really like not really worried about this one. I'm going to be a happy shareholders, and that's going to be fine. If you look at those dividend triangles, by the way, for Apple, Microsoft, and Constellation Software, of course, you have to forgive the Constellation Software to not increase their dividend, but they are just going crazy. For Constellation Software, it's quite interesting because it is one of my rare non-dividend growth stocks. It does pay a dividend, but now it becomes ridiculous. We're talking about I don't even remember, probably 0.15% or something like that. So you really that's really a pure growth play. It's actually 0.13% at the time of recording. So here's the thing: it is a company that allocate all its capital towards creating value for shareholders by making acquisitions, and they are acquiring companies like there's no tomorrow. Very small deals, one after the other. They have an amazing playbook. They have a lot of expertise, and it's doing incredibly well. When you look at their earnings, their revenue, their cash flow from operation, it always goes up. So the main downside here is, of course, their crazy valuation. So the PE ratio is really high on this one. We're talking about 100 right now, but the forward P is a little bit better at 33. When you have a business that makes a lot of acquisition, you have to be very careful about the current PE ratio because it's based on accounting numbers, and then sometimes it could be completely out of whack due to accounting modification. So just be aware of this if you look into Constellation Software. Make sure you understand their business model completely before you jump in, but this one is definitely a keeper for me. All right, Moose. Well, sorry guys, a little bit above 10 minutes, but I think it was worth it. So tomorrow we're going to continue this quick series, and I'm going to look at consumer staples and industrial stocks in my portfolios. All right, take good care, and don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.